7.4%. That's the only number you need to know. We got another read on the inflation front Friday, and it showed that producer prices were up 7.4% year over year. Look, it's a single data point, but it's important for investors because it's a harbinger of the Fed's next move. We are all paying a lot more for goods and services, forcing wages higher, and the cycle continues. All of the above has spilled over into your portfolio with stocks still in the grips of a bear market. This happened all year while the Federal Reserve continued to hike rates in an effort to snuff out an inflation fire that they helped ignite. Think about it. Would you give matches to an arsonist? By the end of this pod, you'll have a better understanding of where we are, what lies ahead, and the difficult decisions you may have to make. Welcome to The Money Runner. I'm David Nelson. Until this year, many investors, including some pretty big money managers, have only known a market where the Fed had your back ready to step in and support asset prices. It's been 14 years since the dawn of the great financial crisis. Every step of the way, the Fed had your back with easy money ready to pump whatever liquidity was needed to shore up confidence. Well, those days have come and gone. The Fed desperately wants us to believe that they are born again, have discovered monetary discipline, and will do whatever it takes to tame the inflation beast. Over the last year, current Fed Chair Jay Powell has worked hard to change the course and restore the Fed's reputation. He wants all of us to know he's not going to roll over. Powell won't say it, but I'm sure the message he wants to send to investors loud and clear is, don't call me daddy. Rich people have known no better friend than the low interest rate, easy money Federal Reserve. So it's with some sadness, I'm sure, that their sugar daddy is gone. Here's a revelation that is sure to shock the government spending progressives. Did you know that the Federal Reserve has been the single biggest contributor to income inequality for more than a decade? Think about it. When you bring your cost of capital close to zero and keep it there, eventually it becomes entrenched in the system. That's exactly what the Fed did. Near zero interest rate policy caused asset valuations to blow out, not just stocks, bonds, and real estate, but almost anything that can be financed. If an asset is worth buying, buy twice as much and just finance it with borrowed money. What difference does it make? Your cost of capital is zero. This is part of the reason housing prices skyrocketed, and don't get me started on car prices. You know who made out? The investor class. If you're working 9 to 5 just trying to make ends meet, not so much. To be fair, in the early days of the financial crisis, much of what the Fed did was absolutely necessary, even heroic. The great financial crisis wasn't just a downturn in the economy. We may have come within weeks of a collapse in the financial system. Many banks were insolvent, and their exposure to bad loans and leverage was massive. The Fed's initial move, spearheaded by then-Fed Chair Ben Bernanke, was to buy up distressed assets so toxic they threatened to destroy the financial system. The Troubled Assets Relief Program, or TARP, was established to stabilize banking institutions, restart credit markets, shore up the auto industry, and finally stabilize American International Group, AIG, an insurance company at the center of the crisis. We can do a whole podcast on AIG, but that's a discussion that needs a big glass of scotch to help it go down. The bottom line, was it necessary? 100%. But it came with the cost of an inflated balance sheet that ballooned to almost $9 trillion at its peak. It didn't help that the easy money dump was redeployed during the COVID-19 pandemic. Ben Bernanke and the Fed were instrumental in stabilizing the financial system and likely helped prevent a depression. Unfortunately, like every other temp relief program out of Washington, it took on a life of its own. The Fed next turned to quantitative easing, purchasing securities in the open market, another tool to keep rates low at the cost of increasing the balance sheet. For the next 13 years, They continued turning on the liquidity machine every time there was a hiccup in the stock market or the economy. We even gave it a name, the Fed put. The Fed wasn't alone. The Biden administration continued priming the pump with a series of relief packages so large that former Secretary of Treasury Larry Summers, a noted Democrat, came out with a warning to President Biden that the continued spending would be inflationary. Fed policy overstaying its welcome collided with Washington politicians writing trillion-dollar checks at the intersection of historic inflation. You're going to be paying a hell of a lot more for everything. At its peak, the Consumer Price Index, CPI, hit a 40-year high. Of course, nothing is forever. We've had good news and bad news on the inflation front over the last several months. But one thing is for certain. No matter how much progress we make taming inflation, the Fed isn't going back to its sugar daddy status. Those days are done. So long, see ya, bye-bye. Say hi to the wife and kids. I can't tell you where rates will finally settle out, but they aren't going back to zero. As the guard said in The Wizard of Oz, no way, no how. What does that mean for investors? It means that the tide isn't going to lift all boats, and some will get swamped if they aren't careful. Over the last decade, investors only had to think about buying the dip, and eventually markets, with the help of a friendly Fed, would make them whole. Today, you got to do the work. Buy and hold is fine, but your entry price matters. So let's pivot back to Friday's inflation report and see where it fits my overall take on the market. Look, it's hot, but when you take in all the data, there are optimistic signs. Peak inflation, I think, is largely behind us. March was likely the high water mark. That's the good news. The bad news is that we're looking at elevated rates for some time. So what does that mean for stocks? It means that there's no free ride anymore. Too many companies over the last several years were built on business models that thrived on cheap money but struggle when rates rise. Remember, when the tide goes out, we get to see who's swimming without any shorts, and it isn't pretty. The first input of most valuation models is the risk-free rate. When that's zero, you can make a case for almost any valuation. When the cost of capital goes up, investors want some food on their plate in the form of earnings, cash flow, and or dividends. That's why values outperform growth all year. The closest parallel to this market is the dot-com bust. Remember the Pets.com sock puppet? As you can see in this chart, value outperformed for the next 8 years. As investors, we have muscle memory. We keep going back to the stocks that made us money. Most bear markets create new leadership for the next leg of the bull market that follows. For many investors, that means buying more Apple, Alphabet, Amazon, Microsoft. Why? Because over the last 10 years, it's worked every time to buy the dip in these names. Technology, that might lead again. After all, they've had the biggest valuation reset, and maybe one of these names will lead us out on the other side, but I doubt it. Apple is hardly the same company Steve Jobs built. Don't get me wrong, Tim Cook is a fabulous operator and generates mountains of cash, but really hands out innovation sparingly in their products. How many of you didn't buy an iPhone 14 because it really wasn't any different than the one you're holding right now? Look, I own this stock, but I'd like to see more innovation. Hey, Tim, start taking some chances and look less like a tech utility company. Amazon is probably the biggest example of a company that will find it difficult to regain its throne. Look at the numbers. With the exception of 2020 and the bump in online spending because of COVID, Amazon's revenue growth has been slowing since 2018. They still need to generate a lot more earnings and cash to get buyers to come back with interest rates rising. Too many better choices to send buyers and their cash out of the jungle we call Amazon. Microsoft maybe has the best shot at regaining its leadership. The FTC has just filed suit to block their takeover of Activision, but even without that, they have a lot of levers to pull. I own this one too, but I'd like to see them focus on driving the core business. Any company the size of Microsoft is going to get scrutiny. At this point, Microsoft, given its history, is going to have to generate the growth organically because the U.S. government isn't going to let them buy it. The message is the next 10 years is going to be a lot different than the last 10, and all of us are going to have to resist the urge of buying only what we know. Especially now that our sugar daddy, the Federal Reserve, has made it clear they will not sweeten things when things get sour. The next leg of a bull market is going to demand that we move out of our comfort zone. If you like today's pod, please hit subscribe. And don't forget to leave comments, good and bad. Helps us get better. Thanks for joining. I'm David Nelson.